Okay, Bismillahirrahmanirrahim. Assalamu alaikum. Let's just start the session. That specific session is on IFRS 16, that is leases. In this session, we'll try to cover all the areas of IFRS 16 leases. That what is a lease agreement and what type of leases are there, and what are the parties and the parties of a lease, and how to recognize the lease agreement. We'll discuss and try to cover each and every area of this IFRS 16, which is tested in F7 financial reporting paper. Okay, let us start from the basics. First of all, what is lease? What is a lease agreement, or what is lease? So let's recall. Lease is basically an agreement. If I would say that what is lease? So lease is an agreement. It's an agreement between two parties. It's an agreement between two parties. Agreement between two parties. In which one party gives a right to use the asset. One party gives the right to use the asset. One party gives the right to use the asset over a period of time, over a period of time, over a period of time, against some consideration. So if I would say, what is a lease agreement? What is a lease? So lease is basically an agreement between two parties in which one party gives a right to use the asset. One party gives the right to use the asset over a period of time, let's say 4 years, 5 years, 6 years, 10 years, against some consideration, against some remuneration. That means if one party gives a right to use the asset over a period of time against some consideration, that agreement is known as a lease agreement. That agreement is known as a lease agreement. So that is known as what? Lease. Now, if we talk about that, lease is an agreement which gives the right to use the asset. One party gives the right to use, no doubt. If I am entering into the agreement of a lease agreement, I am giving a right to use the asset. That asset is mine. I have recorded that asset. I have purchased that asset, and I'm giving that asset to somebody, and I'm giving a right to use that asset. So it means the lease is an agreement which gives right to use the asset, which means in IFRS 16, that right to use an asset is known as what? A leased asset. That is known as what? A leased asset. Number one. Number two, over a period of time, that we will represent that term with the lease term. We'll call in later questions, will call this term as a lease term, and the consideration will be known as what? Consideration will be known as what? A lease liability. Consideration will be known as what? A lease liability. It means one party gives a right to use an asset, that means a lease asset, over a period of time, over a lease term, against some consideration, against the lease liability. So these are the three important terms which will be discussed, which will be discussed, or which will be used in the earlier or the future slides or the questions. Okay, so that was the definition of the lease, that what is the lease agreement. Now let's move on and identify the parties of a lease. What I told you, that lease is an agreement between two parties. It means there are two parties in the lease agreement. The one is known as what? The lessor, and the other one is known as what? The lessee. So it means there are two parties in the lease agreement, that is the lessor and lessee. So there are two parties in the lease, that is the lessor and lessee. Now, who's the lessor? Lessor is the one who gives the right to use the asset. Lessor is the one who gives the right to use the asset, right to use asset. And who the hell the lessee is? Lessee is the one who will gain the right to use the asset, who will gain the right to use the asset, the one who will gain the right to use the asset, right to use the asset, the one who will get the right to use the asset is known as what? A lessee. Now, IFRS 16 specifically gives you, or will let you know, the treatment of leases with respect to lessor and as well as the lessee. It means in IFRS 16, the lessor accounting and the lessee accounting both are discussed in detail. But for F7 or the financial reporting paper, we are about here to discuss only the lessee accounting. Lessor accounting is not the part of F7 financial reporting paper. So we are just going through the lessee accounting in this particular session. So lessee accounting, how the lessee will recognize that asset, what will be the accounting treatment, how to recognize the lease liability. We'll discuss each and everything. So now let's move on again. Types of leases. IFRS 16 specifically identify there are two types of leases. Number one, the finance lease, and number two is the operating lease. There are two types of leases, that is the finance lease and operating lease. And remember, we are just here to discuss the lessee accounting. So we'll discuss each and everything with respect to the lessee. IFRS 16 particularly states that for a lessee, all leases must be classified as as a finance lease. I repeat my words. As per IFRS 16, IFRS 16 is specifically noted that all leases must be classified as finance lease. As you all know that IFRS 16 was earlier known as IAS 17. The title of IAS 17 was quite same. That was leases. IFRS 16, that is leases. There was a major difference. The major difference between the IFRS 16 and IAS 17, that is, in IAS 17, there were 5 criteria. There were 5 recognition criteria. If the lessee fulfills all those 5 criteria, then that lease will be classified as the finance lease. But now all those 5 criteria are omitted. All those 5 criteria are now deleted. Now the IFRS 16 simplified that treatment. IFRS 16 particularly states that all leases must be classified as finance lease. It means normally other 90% leases are classified as finance lease, but yes, IFRS 16 gives the option. In two particular. We'll discuss that operating lease in detail in the later slides. But operating lease, IFRS 16 states that if the company wishes to use wishes to classify the asset, wishes to classify that lease agreement as an operating lease, they can recognize the operating lease. But in two particular situations, if that lease term is equals to or less than 12 months, or number two, or if that lease of a low value item. Now the question arises that what is low value item, we'll discuss later on. We'll discuss this later on in detail. We'll discuss this one, that what is operating lease and how can we recognize the operating lease and what would be the accounting treatment. Inshallah, we are going to discuss it later on. Okay, now we are focusing more on the finance lease, but let's quickly differentiate between these leases, that is the finance lease and the operating lease. First, a statement that I gave you that all leases must be classified as finance lease. Exception is given if the company wants to. If the company wants to classify the lease as an operating lease, yes, they can. But the conditions would be the lease should have been for the less than or equal to 12 months, or it's not a necessary condition, or if the lease of a low value item, then the company may classify that lease as an operating lease. Otherwise, normally the lease would be classified as finance lease. Now, what is the difference between on a layman ground, what is the difference between the finance and the operating lease? The difference between the finance and operating lease is that finance lease, under the finance lease, substantial risk and rewards are transferred to the lessee. Remember, lessor, the one who gives the right to use the asset. Lessee, the one who has a right of used asset. So it means if the substantial risk and rewards, major risk and rewards are transferred to the lessee, now that is known as what the finance lease. Under the finance lease, majority, substantial risk and rewards are transferred to the lessee. While in the operating lease, substantial risk and rewards are retained by lessor. Second difference is generally asset is leased for a long-term period, generally speaking, and operating lease generally, normally, asset is leased for a short-term period. Asset is leased for a short-term period. If the asset is leased for a short-term period, now that lease is known as what? Operating lease. That lease is known as what? Operating lease. Okay. Now the third difference is if the substantial risk and reward are transferred, it means substantial benefits are transferred to the lessee. Now just recall this one. If the substantial risk and reward are transferred to the lessee, risk and rewards are transferred to lessee. Remember what I said? Risk and rewards are, it means the major benefits are transferred to lessee. If major benefits are transferred to the lessee, and don't forget the definition of asset. Asset is which is something in your control. It means risk and reward are in the control, or in the benefit are in the control of lessee. It means risk and reward are in the benefit, or risk and reward are in the hand of lessee. It means asset, that particular asset is controlled by the lessee. The definition of asset was asset must be in control of the party. It means now lessee is the right person who has the control of that asset. Number two, future benefit are expected. Future benefit is expected, and now that asset is in the control of the lessee, and major risk and reward, major benefits are transferred to the lessee. It means now the major benefits are retained by lessee, which means now the major benefit will be retained by lessee. So it means both the definition, both the criteria of the definition of assets are fulfilled in terms of lessee. Lessee is the one who has right now the control on the asset. Number one, major benefit will be retained by the lessee. It means now that asset should have been recorded in the balance sheet of lessee. That's why IFRS 16 states that if there is a finance lease, major risk and rewards are transferred to the lessee, which means now asset will be recorded in the balance sheet of a lessee company. While in the operating lease, where major risk and rewards are retained by lessor, which means asset will be maintained in the balance sheet of lessor. I hope you get this one, that what is finance lease and what is the operating lease. Now we are moving towards the finance lease. That what is the finance lease? Finance lease, we have discussed that finance lease, under the finance lease, major risk and rewards are transferred to the lessee, which means now the control lies with the lessee. Number two, now the major benefits are transferred to the lessee, which means lessee is the person, lessee is the company who will retain the major benefit of that company, major benefit of that asset, which means now the asset should have been recorded in the balance sheet of a lessee company, in the lessee company. Now we are doing what? The lessee accounting. We discussed it earlier that IFRS 16 gives you the accounting treatment of both the lessor and the lessee, but for F7 financial reporting paper, FR paper, we are more concerned regarding the lessee accounting. So lessee accounting under the finance lease, So if we discuss about the finance, we will be discussing the operating lease, the accounting treatment of operating lease later on, inshallah, in the session. The finance lease states that the while lessee is recognizing that lease as a finance lease, now the lessee need to recognize both, that is right of use asset and the lease liability. What does it mean? Try to concentrate this one. Okay, try to concentrate this one, please. For example, if there is a company and there is a B company. A company transferred a machine to B company over a period of 5 years, and the useful life of that asset was also 5 years. A company gave that machine for the purpose of use to B company. Okay. Now B company is transferring that asset to B company. It means now A company will be known as what? Lessor, and B company will be known as what? A lessee. A company gives the right to use the asset to B company. A company is lessor and B company is the lessee company. Okay. Now A company has transferred the major risk and rewards to the B company. B company will be the company who will be using that asset, and the major benefits are retained by now B company. So the lessee will recognize that asset. Lessee will recognize that asset in their accounts, in the balance sheet. Now, how they're going to recognize? Definitely, they will make the entry, that is asset debit and liability credit, as they have not yet paid the amount. So it means the asset will be recognized in the balance sheet of asset, and the most probable accounting entry would be that asset debit and a liability credit. But here IFRS 16 states that will not recognize the term, will not record the term asset, will record, that is right of use asset debit and a lease liability credit. Will not record account payable. If we are going to record the accounts payable, that shows that we need to pay to some certain suppliers, but we are not here to pay any amount to the suppliers. It means right of use asset debit and lease liability credit. So the most probable entry at the time of inception of the lease is going to be that is right of use asset debit and lease liability credit. It means lessee need to account for both, that is the right of use asset and the lease liability. So it means while you're having a finance lease, while you're recognizing the finance lease, the lessee should recognize two line items, that is the right of use asset and the lease liability, which means while you are preparing the balance sheet, you need to recognize asset. It means in the balance sheet assets, under the head of assets, under the head of non-current asset, you have multiple assets right now: property, plant and equipment, investment property. Thereby, let's welcome right of use asset, another asset in the balance sheet. Whenever you see a financial statement of a company, of a particular company, and if there is an asset with the name of right of use asset, always get it, always try to understand that right of use asset represents that there are some assets which the company bought on lease agreement, it means the property, plant and equipment. Property, plant and equipment is the asset, is the property, plant or equipment that is for the purpose of use. Investment property, these are the non-current assets which are bought for the purpose of capital appreciation or for rental purpose. And right of use asset are those assets or those machines which are bought on a lease agreement. So this will represent you that these are some assets which are bought on lease agreement. So it means the company will recognize two line items, that is the right of use asset and lease liability. Now the question arises, how to calculate the right of use asset and how to calculate the lease liability. Now the first step is to calculate the lease liability. So why not the right of use asset? You will get to know. In later slides. Right now we are going the first step, that is to calculate the lease liability. We are going to calculate the lease liability. Now, what is the step or the procedure to calculate the lease liability? First of all, let's try to understand the term lease liability. The term lease liability means the liability of a lessee with respect to the lease agreement. The liability of the lessee with respect to the lease agreement. Please try to listen to my words. What I said, the liability of the lessee with respect to the lease agreement. It means what liability arose because of that lease agreement. If the lessee company entered into the lease agreement, what sort of liabilities, what sort of obligation has arisen because of this lease agreement? Now let's try to identify those obligations or the liabilities. Number one, the first liability or the obligation, lessee will have to pay the fixed amount of rental over the period of 5 or 7 years, over the period of lease term. For example, if the lessee entered into the lease agreement for a period of over 5 years, it means now the lessee will have to pay a fixed amount of rental over the period of 5 years. It means the first liability or the obligation that is recognized, that is on the lessee, is the fixed payments or the rentals that will be recognized, that will be paid in future terms, in the future lease terms. The first liability, that is the future rentals, that is a fixed payment. Number two, that is the guaranteed residual value. Now, what is that guaranteed residual value? It's a guaranteed amount that would be paid by lessee at the end of lease term. What I said, it's a guaranteed amount that would be paid by lessee at the end of the lease term. Let's take an example. A company leased that asset to B company. It means B company is the lessee company. Now there's an agreement. In the lease agreement, there is a clause that the lessee would pay an additional amount at the end of the lease term if the lessor would not be able to sell that asset in the market at that prescribed price. For example, lessor said that I'm giving you that asset on a lease to you for over a period of 5 years. After 5 years, just give that asset back to me. I will try to sell it out in the market. If I won't get the price which is desired by me, definitely now the lessee would purchase that asset. That is written in the agreement. That is the clause of that agreement. Now the lessee would pay a certain amount, let's say $500,000 or $50,000 or $70,000 It means now the lessee would pay that amount to the lessor, and that amount is known as what? The guaranteed residual value. That is the scrap value. Guaranteed scrap value, that at the end of the lease term, the lessee will have to pay that amount to the lessor at the end of the lease term. That is known as what? A guaranteed residual value. So if the lessee has an agreement with the lessor, and in that agreement, lessee committed that yes, at the end of the lease term, I would pay the guaranteed residual value, GRV. I would pay the guaranteed residual value. It means now the lessee has an obligation to pay that amount at the end of the lease term. Which means if you have an obligation, right now you have an obligation to pay that amount at the end of the lease term. So it means this would be recognized as an obligation or the liability. So that is also the liability. What I said, liability, an obligation because of that lease agreement. So it means now the lessee has got the liability because of that lease agreement. So that is known as what? The guaranteed residual value. Now, like guaranteed residual value, there is another component, that is the bargain purchase option, that is known as what? BPO. And remember, both guaranteed residual value and bargain purchase option, they both are more or less the same. They are more or less same, but will not always remember, in question or in agreement, even in agreement, these two components will not be the part of an agreement. Either there will be a guaranteed residual value or the bargain purchase option. Now, what is bargain purchase option? Now, here the lessor gives an optional requirement. Remember, the difference between the guaranteed residual value and the bargain purchase option is guaranteed residual value is mandatory. It's mandatory. Lessor has made it mandatory in the agreement that lessee, you have to, you will, you should pay that amount at the end of the lease term. But in the bargain purchase option, as we can see that there is option. Lessor has given the option to the lessee that at the end of the lease term, if you wish to, there is an option. If you wish to continue, if you wish to purchase that asset, then just give me the minimum amount, the minute amount, the nominal amount, and you just buy that asset. Legal term, legal agreement, legal ownership will also be transferred to you. It means that is known as what? Bargain purchase option. For instance, lessor transferred that asset to you and gave a right, an option to buy that asset at the end of the lease term by paying a nominal amount. Let's say $5,000, and that the legal ownership will be transferred to you, which means now the lessor has given a bargain purchase option. If lessee says that, okay, at the end of the lease term, I'm going to buy that asset at a nominal amount, it means now the lessee has another obligation, that is, I need to pay that amount at the end of the lease term. It means the lessee has an obligation. Now that obligation of the liability, again, because of the lease agreement, so that is also the part of your lease liability. And I said earlier that either there will be a guaranteed residual value or the bargain purchase option. Both are same, that at the end of the lease term, lessee will have to pay the amount to the lessor. But in guaranteed residual value, the difference between the guaranteed residual value, it's guaranteed, it's mandatory. But in bargain purchase option, it's optional, it's not mandate, it's not compulsory, it's optional. So either there will be a guaranteed residual value or there will be a bargain purchase option. So at the end of the lease term, the lessee has to pay that amount. It means it's a lease liability. Okay. The last component is that is the lease termination penalties. If, for example, lessee thinks that at the time of inception thinks that there is a clause of penalty, that if the lessee has some breach of contract or breach of agreement during the lease term, then the lessee would have to pay some penalties. If the lessee thinks that on the basis of the past experience, we had multiple lease commitments, but during the lease commitment, we had some breaches, or we had some non-compliance of the agreement, because of which we need to pay the penalties. And if lessee thinks that there will be some penalties that will be required to pay, so it means again that is the obligation on the lessee because of that lease agreement. So this would also become the part of your lease liability. So normally lease liability have four components. There are four components. That is the fixed rental, the guaranteed residual value, the bargain purchase option, and the termination penalties. Now remember, these all payments are required to be paid at the end of the lease term, that is after 5 years. These are the future payments. Mark my words. What I said, these all are the future payments, and we are going to record that liability today at present. And I know that you got it. You must have some in your mind, and you would definitely say that if there is these are the future payments, if these values are the future values, and we need to recognize that liability at present, we need to recognize all these payment at the present value. And for the calculation of the present value, we need interest rate, and implicit interest rate would be used. Implicit interest rate would be used. So it means all these payments must be measured or recorded at the present value, and for the calculation of the present value, implicit interest rate is used. So these are the components of lease liability. These components will be added up, and after adding all these components, we'll calculate the present value, and will recognize that lease liability at the present value of lease payments. Okay. So that was the calculation or the process of calculation of the lease liability. With respect to exam point of view, with respect to examination situation, in 99% situation, examiner would provide you the present value. You're not supposed to calculate the present value, but in this session, we'll try to calculate the present value. That if in 1% situation, what if the examiner doesn't provide you with the present value, then how to calculate the present value of all these lease payment. We'll try to calculate this one. Okay, let's move on. The second step is to calculate the right of use asset. And what are the components? Remember, the right of use asset is the asset. It's like a normal asset. It's like a normal asset. For example, if the property, plant and equipment, we are there to calculate the we already discussed, you must have discussed, you must have calculated the cost of non-current of the property, plant and equipment under IS 16. Then how to calculate the cost of property, plant and equipment? Number one, list price, less discounts, and then add transportation cost, insurance and transit, and multiple components were there to calculate the cost of a property, plant and equipment. Likewise, we are here to calculate the cost of a right of use asset. Then how to calculate the right of use asset? Now the components of right of use asset. Number one, the first one is the present value of lease liability, and that was calculated under step one. Now you must have gone through this one. You must have got it. So why we calculated the lease liability first instead of the right of use? As because the present value of that lease liability, the present value of lease liability would be the first component of the right of use asset. So right of use, how to calculate the right of use asset? Right of use asset, the first component of the right of use asset, that is the present value of lease liability, which was calculated in step one. Second thing is initial direct cost. Initial direct cost, the examples of initial direct costs are there. That is any commission you pay, legal fees, or the cost of negotiating the lease terms and agreements or the contract conditions, cost of arranging collateral, and the payments made existing tenants to obtain the lease. It means any payment which is done in respect of the lease agreement, any legal charges. So that would be known as what? The initial direct cost. We'll add this initial direct cost, and that initial direct cost is also known as initial payments. Remember, okay? Initial payments or initial direct cost. And then less any lease incentive that is provided by the lessor. If lessor has provided you any incentive, any benefit, any discount, so that would be deducted, or that would be reduced from the initial direct cost. Okay. Third component is the present value of dismantling cost. What if you have installed that asset, the right of use asset, and you know that after 5 years you need to dismantle, you need to remove that asset. So you have to calculate the present value of that dismantling cost, and will add in the value of right of use asset. Any down payment or the advance you made, that would also become the part of your right of use asset. So right of use asset, it has four components. That is, number one, the present value of lease liability, that was calculated under step one. Number two, initial direct cost would be added and lease incentive would be deducted. Third one is the present value of the dismantling cost would be added, and the last one is the down payment or the advance paid by lessee at the inception of the lease would also be the part of your right of use asset. Okay. The second thing is, if you are recognizing the right of use asset, and we know that right of use asset is the component of assets and it's a component of non-current asset. So we need to depreciate. As now lessee is the person, lessee is the company who's recognizing that asset. It means now the depreciation will also be charged by the lessee company. So what is the rule for the depreciation mentioned in IFRS 16? Depreciation is charged over the shorter of. Depreciation is charged over the shorter of. It means if you are going to calculate the depreciation, we need life. Now life would be the shorter of. Life would be the shorter of what? Assets, useful life, and the lease term. For instance, I bought an asset, that is, I am a lessee company. I bought an asset for lease over the period of 4 years, and the useful life of that asset is 6 years. Now there's a confusion that right of use asset, which I have calculated the amount of right of use asset. Let's say the right of use asset which I have calculated is 500,000, or let's say 10 million or 1 million. Right of use asset, the amount of right of use asset is 1 million. Now I need to divide or to depreciate that asset over the period of life. Now what should be the life? Either it should be the asset useful life, that is 6 years, or the lease term, that is 4 years. So IFRS 16 states that the life should be taken over the shorter of, whichever is shorter. It means now right now lease term is shorter. Now the assets would be depreciated over the period of 4 years. But there is an exemption, or there is a note, or there's a disclaimer. If the legal ownership is transferred at the end of the lease term, then depreciation is charged over the period of assets useful life and not the lease term. Which means if in the question or in the agreement it is stated that at the end of the 4 years, legal ownership will be transferred to the lessee. Now the lessee would depreciate that asset over the period of assets useful life rather than the lease term. So at that situation, at that point of time, will not consider the rule of shorter of. Will just depreciate that asset over the period of assets useful life. Okay. Now lease agreement, let's move on towards the question side or the practice side. If we talk about the lease agreement, normally whenever we sign the lease agreement, there are two types of condition. That is, sometimes the lease agreement is on the arrears basis, or sometimes the lease agreement is on the advance basis. Now what is the difference between these two? In case of arrears, lease payments or lease rentals are paid. Lease rentals are paid at the end of accounting period. 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 While in case of the advance, lease rentals, annual lease rentals. Okay. Annual lease rentals are paid at the start of every year. At the start of every year. So that is the major difference. And is there would be any difference in the accounting treatment? Yes, there would be a little difference, and we'll discuss this one as well. So let's start with the arrears case. What if the company is paying that rental at the end of the accounting period? So what would be the accounting treatment and how to solve the question, and what would be the strategy to solve this question? Okay. Now we have a question, that is, Riyadh company enters into a lease agreement to lease an asset. The term for the lease are as follows. That is, number one, the first clause of the lease agreement, primary period is for 4 years. That is, 4 years is the lease term. Okay. From 1st January 2002, that is the inception of the lease, the start of the lease, with a rental of $2,000 per annum, PA, that is per annum payable on 31st December each year. It means rentals are paid at the end of the accounting period, which means that is the case of arrears. Now there is a 2,000 rental per annum payable every year. That is the fixed rental, annual rental for annual rental. That is the fixed rental or the fixed payment. That is a rental that would be paid at the end of the each year and for the period of 4 years. Okay. Second clause is the present value of the lease payment is 5710. That is the present value of lease payment. It means examiner has already provided you with the present value of lease liability. Present value of lease liability. But remember, lease liability has multiple components. Number one, the fixed rentals. Number two, that is the guaranteed residual value. bargain purchase option, and any penalties. We need to calculate the present value of all four components. But right now, examiner has given you the net amount, the total amount, or the final outcome. That is the present value of lease payment. It means it includes everything. There is no need to calculate anything in addition. The implicit interest rate is 15%. Now, what is the requirement? Show the financial statement extracts for the year ended 31st December 2002 and 31st December 2003. It means I need to prepare the extracts of the financial statements for 2 years, that is 2002 and 2003. For this question, we'll try to cover up each and every area, and we'll discuss that what possible requirements that examiner might ask you in exams. Okay, now let's start with the solution. That is, first of all, the step one, that is to calculate step one. Step one, what is that? Step one. Step one is to calculate what? Lease liability. Okay. But right now in this question, present value of lease liability or lease payment is already given, and that was $5710. Am I right? Yes, 5710 is the lease liability. Now step two, what is this step two? Step two, that is to calculate the right of use asset. And how to calculate the right of use asset? Don't forget, right of use asset, the first component of the right of use asset, that is the present value of lease liability, that is 5710. Second, initial direct cost, if any, we don't have. Incentive would definitely we must have deducted that one, but there is no lease incentive, there is no initial direct cost, there is no advance. There is no advance, so it means the right of use asset, the amount of right of use asset would be 5710. So it's a coincidence that the present value of lease liability and the right of use assets are equal. It's not mandatory. Okay, it's not mandatory. There might be a difference between the lease liability and the right of use asset. So the right of use asset is 5710. Now step 1 and 2, after performing the step 1 and 2, we need to recognize. So the accounting entry would have been right of use asset debit and the lease liability credit with the value of 5710. Now that is the recognition at the time of inception. This is known as what? Initial recognition. Initial recognition. Now what should be the procedure for subsequent recognition? Right of use asset would be recognized at its carrying amount. It means at the end of the year one, we'll calculate the depreciation and we'll calculate the carrying amount of the right of use, and this will be recorded in the balance sheet. How the lease liability would be recorded or accounted for? This would be accounted for. At the amortized way, or we need to prepare the lease amortization schedule. So that is the schedule or the format of the schedule. Let's recall the column of this lease amortization schedule. Number one, the first column is the years, second was the rental, third one is the interest, and fourth one is the principal, last one is the balance column. Now how to fill up this table? Let's start. First of all, we have a lease liability, the present value of the lease liability, that is 5710. 57, the balance, that is 5710, and that is on 1st of January when we had an agreement. Let's look it out. 1st January 20x2, that is the date of agreement. At this date, we had an agreement, and at that date of agreement or the inception of the lease, we had a lease liability of 5710. Now, let's recall or look at the question. When we are going to pay off that rentals, we are going to pay that rentals at the end of accounting period, that is 31st of December each year. So rentals would be paid at 31st December 2002. Am I right? 1st January 20x2, there was a lease agreement, and at the end of the accounting period, that is 31st December 20x2, will pay off the rental. Another rental would be paid at 31st December 2003. Third rental would be paid at the end of 31st December 2004. So how many years the lease agreement is for? That is 4 years. And the last rental would be paid at 31st December 20x5. Okay, so actually the requirement is for 2 years. That is, we need to prepare the extract of 2 years. But that is the first question, and we'll discuss each and every aspect of the question. So we'll have the accounting treatment for over the lease term, that is for the 4 years. Okay. On 31st December 20x2, definitely company would have paid the rental of $2,000. Okay. Now, once the company is paying at the end of the accounting period, the lease rental of $2,000, now the question arises, what is that $2,000 and what it comprises of? Remember, we had a lease liability of 5710 at the start of the year. Okay, liability, it was an obligation. And throughout the year, that liability was due. And on 31st December, from January till December, for the whole year, that liability was due on the lessee. And we all know that once the obligation is due over a period, it means for a year, now the interest would be applicable. Interest would be charged on that liability. It means 5710, that was the obligation or the liability that was due over the period, over the year. Now the interest rate, the rate of interest was 15%. Rate of interest was 15%. 5710, that is 15%. This would make 857. 857. It means if I'm paying a rental of 2000, in this rental, what I'm paying to the lessor, I'm paying 857 as an interest. In this a 2000 rental, I'm paying 857, the amount of 857 as an interest. That is a finance cost I'm paying to the lessor. And the remaining amount, that is 8000 minus 857, and the remaining amount, that is 1143, which I have paid to the lessor. Remember, I paid to the lessor, that is $2000, out of which 857 is the finance cost. So remaining amount is, that is 1143. 1143 is the amount of interest. So the remaining balance, now the remaining balance, what is the amount of remaining balance? Let's calculate the amount of remaining balance. Five seven one zero minus, that is subtract 1143, that is 4567. 4567. Sorry, 1143 is the amount of principal which we have paid to the lessor. So now the balance amount is 5710. That was the initial lease liability, out of which 1143 is paid to the supplier. Liability is paid to the supplier. Now the balance amount is 4567. Okay, one more thing. Remember that 5710 is the liability. It's the lease obligation. It's the lease liability. It does not include the interest. That 5710 is exclusively a loan. It's a liability. Its interest is not included in that amount. So out of 5710, I paid a principal or the liability amount, that is 1143. So the remaining obligation or the liability or the loan amount is, that is 4567. Now again, next year, during the course of the next year, company would have paid at the end of the 2003, that is $2000, a rental of $2000, and now 4567. From 31st December 2002 till 31st December 2003, during the course of the whole year, that is for the period of 12 months, again the liability was due, and on that liability will apply an interest rate of 15%. This will make 685. It means while paying the rental of $2000, lessee would be paying interest of 685, which means 2000 minus 685, this will make 1315. It means the lessee has paid the principal of 1315, which means out of 4567 minus 1315 is the principal already paid. Now the remaining obligation or the remaining liability or the balance liability is 3252. Again, from 31st December 2003 till 31st December 2004, again at the end of the year 4, company would have paid a rental of 2000, and out of that 3252, the obligation that was pending throughout the year was 3252. Again, a 15% interest is charged, that is the amount 488. Out of 2000, 488 is the amount of interest, which means now the company has paid the principal amount or the liability, that is 1512. Out of 3252 minus 1512, company has paid the lease liability, which means the remaining lease liability is 1740. Again, 31st December 20x4 till 31st December 20x5, a whole year passed on, And again, the rental would be paid at the last rental would be paid at the end of the 31st December 20x5, 2000 rental. And now again 1740 is the remaining lease liability on which the interest rate would be applied, that is 261. 2000 out of 2000, 261 is the amount of interest paid, which means 1739, that is approximately 1740 is the amount of principal is paid. Now the remaining liability at the end of the lease term would be zero, and that makes sense. That makes sense. Is it clear to everyone? This is the lease schedule. This is the lease schedule. This is the lease amortization schedule. This is the lease amortization schedule which we have prepared. Yes, is it clear to everyone? Is there any question? Is there any question to you guys? You may ask, definitely. Definitely you may ask. This is the lease amortization schedule you need to prepare. So is there any need to prepare the whole lease amortization schedule in exam? No, you have to be exam specific. You have to be requirement specific. We'll discuss this one in the next question. Is there any confusion of the problem in this lease amortization? That table is known as lease amortization schedule. We'll be moving towards the exam requirements now. We are moving towards the exam requirements. Before that, if you have any question, please you may ask. Okay, now let's move on. That is the lease amortization schedule. That is the lease amortization schedule we have. And now we are moving on towards the requirement. That is the extracts. Remember, lease amortization schedule. The preparation of the lease amortization schedule is not the exam requirement. Is not the exam requirement. That is the tool to fulfill the exam requirement. The main exam requirement, that is the extracts. Extracts of the financial statement. Extracts of the financial statement. Okay, we are going to prepare the extracts of the financial statement, and we know that the main components of the financial statement, that is the income statement, and second one is the balance sheet. So we are going to prepare the extracts of the financial statement. First of all, we are going to prepare the extracts of the financial statement for the year ended 31st December 20x2. We are going to prepare the financial statement of 31st December 20x2. Now, in income statement for the year ended 31st December 2002, in income statement, what would be recorded? What line items would be recorded? Two line items would be recorded. Number one, the finance cost, that is interest expense, and second one is the depreciation. Now, what would be the finance cost for the year ended 31st December 2002? Now, look at the table. On 31st December 2002, on 31st December 2002, at the end of the year, we had a finance cost. We had an interest expense of 857. How? On 1st January 2002, there was an initial lease liability was 5710. From 1st January till 31st December, that liability was due. And at the end of the year, we calculate the interest on that liability, which means 857. So interest expense that would be reported, finance cost that would be reported in P&L, that is 857. And how to calculate the depreciation expense? Depreciation expense would be calculated right of use asset divided by life. Right of use asset divided by life. So what is the right of use? The amount of right of use asset was 5710 divided by. Okay, now let's recall the question. The lease agreement is for 4 years, and the life of the asset is not given in the question. So it means this will be decided, or this will be divided over the period of 4 years. So 5710 divided by 4, that is 1428. 1428. Okay. If the life of the asset would have been given, for instance, 7 years, so what is the rule for the depreciation? Depreciation should be charged over the shorter of life. So it means definitely would have charged over the period of 4 years. Right now, life of the asset is not given. We can consider, we can assume that that was the equal, the life was equal to the lease term. Okay. Now, that was the extract of the income statement. Only two line items will be recorded with respect to that question, that is finance cost and the depreciation. Now, let's move on towards the balance sheet side. First of all, in the balance sheet side, we are going to recognize the asset, and the asset would have been the right of use asset. The cost of the right of use asset was 5710, but we need to eliminate or deduct the depreciation, accumulated depreciation, that is 1428. 5710 minus 1428, this will make 4282. It means the right of asset that would be reported in the balance sheet with the amount of 4282. Remember that we are preparing the extract of 31st December 2002. What if we are preparing the extract of 31st December 2003, which means 5710 minus accumulated depreciation of 2 years. Okay, remember, don't forget, 4282 or value of right of use asset, this will not be recorded same in 2003. That would definitely be changed. Okay, in balance sheet, another component we are going to record, that is the lease liability, a liability section in which we are going to recognize the lease liability, but this will be broken down into, that is the current liability and long term liability. Current liability and the long term liability. Now try to understand this one. At the end of the 31st December, we are preparing the financial statement, that is at the end of 2002. At the end of 2002, we have a total lease liability of 4567. Am I right? It means at 31st December 2002, we have a lease liability of 4567. That is the total obligation. So what is that? That obligation, that amount is known as what? The total obligation, that is the total liability at the end of the accounting period. And now 4567, out of which we need to pay some liability or the amount in a very next period, in within the 12 months, And what amount is required to pay within the 12 months? That means in next 12 months, we'll be paying 1315 out of 4567 within 12 months. It means at the end of 31st December 2003, we are here to pay that amount on 31st December 2003, which means 1315 is the obligation that will be settled within the next 12 months. It means 1313 is the current liability. And the remaining, after deducting that from 4567, the remaining liability 3252, that is the liability that would be paid after the 12 months. That would be termed as what? Long-term liability. Long-term liability. Now let's recall. Please go through this one. Is it clear? Is it clear to everyone? Please go through to this one. Is it clear to everyone? Please get it. Please note it down. Is it clear to everyone? Out of the total liability, we are going to pay some amount in the next 12 months, and that amount is 1315. And next month, it means next 12 months, it means 1315 would be recognized as the current liability, and the remaining, that is 3252, would be recognized as the long-term liability. Long-term liability. Okay, now the exam requirement, current liability. The current liability is 1315 and the long-term liability is 3252, and definitely the total liability would be the sum of both. So maximum requirement that examiner can test in your paper, that is first requirement, what would be the finance cost to be charged? Number two, what would be the amount of depreciation would be recognized? Number three, what would be the value of right of use asset at the end of 2002? What would be the amount of current liability and what would be the amount of long-term liability? Maximum these 5 requirements are tested in this standard. Remember, that was the financial extract of 2002. But in this question, the requirement is of, that is, we need to prepare the extract of 2003, and now how the extract of 2003 would be prepared. Let's have a look on this one. Financial statement extracts, that is income statement and balance sheet. In income statement, we are going to record the depreciation and the finance cost as an expense. In balance sheet, we are going to, that is on 31st December 2003. Okay, balance sheet, we are going to recognize the asset, that is right of use asset, and in liability side, we are going to recognize the lease liability, and lease liability would be broken down into, that is the current liability and the long-term liability. I would recommend please solve it by yourself. Please put all the data in this question. We'll put all the data in this format. Okay, you try by yourself. Let me give you an idea. 31st December 2003. At the end of 2003, finance cost that would be recognized in 2003, that would be 685. And at the end of 2003, total liability was 3252, and out of which 1512 would be paid in the next accounting period, that is current liability, and 1740 would be the long-term liability. I hope you will get this one. Please note it down, and then we'll move on. Okay, now let's move on towards the question number 2. Let's have a look on this question, and we'll prepare the extract of financial statement with respect to requirement that is for the year ended 2002. Let's recall the question. Lion enters into a contract of 5 years lease, that is the lease term of a building on 1st January 20x1, which is the remaining useful life of 10 years. It means the life of the asset is 10 years, and depreciation, with respect to depreciation, the depreciation would be calculated over the period of shorter of, that is the lease term and the useful life. And if the ownership is transferred at the end of the lease term, now then the depreciation will be calculated. Over the period of asset useful life. Okay. Lease payments are $50,000 per annum payable in arrears, that is at the end of the year. That is the annual lease payments. Lion company incurred initial direct cost of $20,000 and receives a lease incentive of $5,000. There is no transfer of the asset at the end of the lease and no purchase option. It means we are going to depreciate that asset over the period, over the shorter of, that is the lease term or the useful life. The interest rate implicit in the lease is not given in the question, but the incremental borrowing rate is 5%. We need to calculate the, we need to prepare the financial extract of this question. Okay, let's start. Okay, let's start. The first step, that was the first step is to calculate the step 1, that is to calculate the lease liability. But in that question, the lease liability is not given in the question. Lease liability is not given in this question. So what is that 50,000? That is the annual lease payment. It's not a lease liability. So what I told you earlier, that in majority of the question, in the majority of the question, lease liability will always be given. Present value of lease liability will always be given in the question. But what if the examiner is not giving you the lease liability? Then how to calculate the lease liability? Let's have a look on this one. How to calculate the lease liability, the present value of lease liability. So the formula of the present value of lease liability is, that is R into, that is regular payment, multiplied by 1 minus 1 plus I power minus n over I. Let's fill up this information. Regular payment, that is regular payment of 50,000 per annum. Multiply by 1 minus 1 plus I. The interest rate is 5%. That is 1.05. 1 plus R or I, that is interest rate 1.05 power n, and the lease agreement is for 5 years. Lease agreement, not 10 years. 10 years is the life of the asset. Lease term is for 5 years, minus 5 over 0.05, that is interest. It's not 1 plus I, it's interest. Okay, now put all these figures in a scientific calculator so that we can have okay, 50,000 multiply by bracket and fraction, that is 1 minus bracket open 1.05 bracket close power minus 5 divided by 0.05 bracket close, and this makes present value of lease liability 216473. 216473, that is the present value of lease liability. Present value of lease liability which we have calculated. So that was the present value of lease liability which we have calculated. That was not given in the question. So step number one, that is the present value of lease liability is calculated. Step number two, let's calculate the right of use asset. Right of use asset. Now how to calculate the right of use asset? First component was the present value of lease liability, that is 216,473. Second is indirect cost, if there is any. Yes, there is indirect cost of 20,000. So we'll add this indirect cost of 20,000, and lease incentive will be deducted. So we are going to minus it or deduct it. 216,473 plus 20,000 minus 5,000. This will make 231,473. 231,473. That is the value of right of use asset that will be recognized in the initial balance sheet. So two main components that we have identified: the lease liability and the right of use asset. Now right of use asset will subsequently be depreciated and will be recorded in balance sheet, while the lease liability would be unwound. As we normally record the liability at the present value, and then by the passage of time we are doing what? Unwinding. That is unwinding. We are doing unwinding of interest. Okay. Now let's complete this table with respect to a requirement. First of all, the lease agreement was started on 1st January 20x2, and there we had the present value of lease liability which we have calculated, 216,473. 216,473. That was the initial lease liability that was recorded on 1st January 2002. First rental was paid on 31st of December 20x2. 31st December, sorry, 20x1. That is 20x1. 20x1. Okay. 31st December 20x1. So, but the requirement is for 20x2. Yes, but we need to follow the steps. We cannot directly move on towards the 20x2. On 31st December 20x1, we paid a rental of $50,000. If I'm not wrong, yes, $50,000. And then 216,473. 216,473. 216,473, and the rate of interest is 5%. 10824. It means 216,473, out of which when the rental was paid 50,000, that rental includes the amount of interest 10824. That is 50,000 minus this one. This means that principal which is paid 39176, which means 216,473 minus 39176, 177,296, 177,296. 177,296 is the remaining liability. 31st December 20x2. Second payment was made on 31st December 2002 for $50,000, and again 177,296 interest rate would be applied on that liability amount. This will make 8865. 8865 out of 50,000. 8865 is the interest, which means the principal paid is 41135. Out of 177,296, principal is paid 41135, which means the remaining liability is 136,158. 136,158 is the remaining liability. 31st December 2003. So if the requirement is to prepare the extracts of 2002, why we are moving towards the 2003? Just because we need to identify the current liabilities. This can be known through the next row. So 50,000 is the lease rental. Again, 136,158 was the remaining liability, and on which interest rate is applied, that is 6807 or 6808 is the interest. 50,000 out of 50,000. If the interest is 6808, the principal paid 43192, and the remaining liability would be 136,158 minus answer, that is 92965. 92965. Okay, now let's move on towards the exam requirements. If we are preparing the financial statement extract for the year ended 31st December 2002. Okay, 31st December 2002 income statement will have a depreciation and the finance cost. Okay, it means year two, the accounting for the year two. Finance cost that would be recorded as for 2002, the finance cost that would be recorded as that is 8865. The finance cost, that is 8865, is the finance cost to be reported. Balance sheet, the depreciation, the right of use asset was 231473. 231473 divided by the lease term is for 5 years. So divided by 5 years, 231473. 231473 divided by 5 years, that is 46295. That is the amount of depreciation charged for the year ended 31st December 2002. Now let's move on towards the balance sheet side. We are going to recognize the right of use asset. The right of use asset, the amount was 231473, but remember we need to deduct the depreciation for 2 years. That is the carrying amount. We need to calculate the carrying amount, cost minus accumulated depreciation. The annual depreciation is 46294 multiplied by 2. That means the depreciation for 2 years is 92589, and we'll deduct this one from 231473. 231473 minus, so the book value minus accumulated depreciation. So the right of use that would be recorded as 13884. 13884, that would be the amount of right of use asset that would be shown in the balance sheet. Now let's move on towards the liability side. Liability, we need to recognize the current liability first. Now the current liability, let's recall the current liability. At the end of 2002, the total liability is 136,158, out of which you need to pay 43192 in the next 12 months. That means 43192 is the current liability, and the remaining, that is 92965, would be recognized as a long-term liability. 92965 is the long-term liability that would be recognized. In the balance sheet. So this is the extract of the financial statement for the year ended 31st December 2002. I hope it's clear to everyone. I hope that is clear to everyone. If any confusion, please you may ask in your chat box. Okay, now let's move on towards the next slide. Now we are having, if the lease payment are in advance, so what would be the accounting procedure? What would be the change? Let's recall. So what change we might have in this question? A line enter into a 5-year lease. Again, the lease term is for 5 years, and the remaining useful life is 10 years. These payments are $50,000 per annum payable in advance. Now that is the hint or the indicator. This will let you know that what if this is the advance case or the arrears case. Company incurs a direct initial cost or initial direct cost of 20,000 and receives an incentive of 5,000. There is no transfer of asset at the end of the lease term. Implicit rate is 5%. At the commencement date, Lion Company pays initial $50,000. That is the advance or the down payment. That is the first rental or the advance or the down payment paid by the lessee company. Okay. Now let's prepare the lease schedule. Before we prepare the lease schedule, we need to calculate the step 1, that is the lease liability. Again, the lease liability is not given in the question. We need to calculate the lease liability, but in case of the advance, the formula for the lease liability is, or the present value is, that is present value of lease liability is equal to what? R into 1 minus 1 plus I power minus n over I bracket close, multiply by 1 plus I. Remember, in case of the advance rentals, how to calculate the present value? We need to add on the factor. We need to multiply the factor at the end of the formula. Okay. Let's put on the formula each and everything. That is 50,000 multiplied by 1 minus 1 plus I, that is 5%, 1.05 power minus, I guess minus 5, yes, minus 5 over 0.05 bracket close multiply by 1.05. Let's put on each and everything in the scientific calculator. So 50,000 multiply by bracket open fraction, that is 1 minus bracket open 1.05 bracket close power minus 5 denominator 0.05 main bracket close multiply by 1.05, and the answer is double to present value of lease liability, that is double to 7297. Okay, now one more thing, that is the present value, that is the present value of all lease payment. And what does it mean? It means it's a present value of all lease payment. It means the present value of the 5 lease payment, which includes the first payment which was made on the inception, at the inception of the lease. It means the lease rental which you paid on 1st January, that is also included in that amount. Or please remember, mark my words, I said that 22729, just mark it. We used 5 years in that formula, which means we have calculated the present value of all lease payment, which includes the first payment that was made on the 1st of January, that is at the date of inception, that is at the inception date, which means 50,000 of the first rental, that is advance, is also included in that lease payment or the lease amount. Now let's calculate the step 2. Step 2, that is the right of use asset. And what is the formula to calculate the right of use asset? Number 1, the present value of lease liability, which is 227,297 plus initial direct cost, if there is any. Yes, there is initial direct cost of 20,000 plus down payment. Now let's recall, down payment means the advance. So there is an advance of 50,000. Are we going to include this one? No, we are not going to include this down payment. Reason being that 227,297 is already included. That 50,000 is already included that in that amount. There is no need to calculate. There is no need to add up that 50,000. Otherwise, there will be a duplication. Remember my words. This is the present value of lease payment. So we are not going to include the advance as it is already included in the present value of lease payment. Okay. Now, initial direct cost was added in the cost, and the last one is the incentive paid, that is 5,000. This would be deducted. So 227,297 plus 20,000 and minus 5,000. The net resultant or the right of use asset is 24,227. So that is the right of use asset. That is the right of use asset which we have calculated. Okay. So now let's move on towards the schedule side. The lease rental was started, or the lease agreement was started on 1st January 2001, and the lease liability which we have calculated, that is 227,297. That is the lease liability, initial lease liability that was calculated on 1st January 2001. Now, please concentrate on this one. We paid the first rental on 1st January 2001, and the first rental was 50,000. We paid the first rental on 1st January 2001 with the amount of 50,000. Okay. Now, earlier in the arrears case, what we were doing, we said that in the first rental we have basically made two payments. Number one, the interest, and number 2 is principal. But here right now on 1st January 2001 we had an agreement, and on 1st January 2001 we are making the payment. On 1st January 2001 we had a liability of 227,297, and on 1st January 2001 we are making a payment of 50,000. Now my question is there any interest on that liability? No, there is no interest on that liability. Reason being, liability, the interest arises when the liability is due over the period. It's the first day, and on the first day we are making the payment. It means no interest is calculated on that liability, which means the amount of interest would be zero. Amount of interest would be zero, which means a point to be noted. Point to be noted on in case of the advance, the first rental would be deducted or would be paid as the principal amount, as the liability amount. No interest is charged on that amount. No interest would be deducted in that rental, as because on the 1st January, that is the date of inception, that is the first date of the lease agreement, and on the first day we paid the amount of 50,000, which means no liability was due over the period. It means no interest would be calculated, which means on the first rental, in the first rental, we are exclusively paying the amount of principal. Okay, now 227,297, that was the total liability, out of which we paid the liability of 50,000, which will make 177,297. That is now the lease liability that was due on 1st January 2001. And simply if you simplify this one, that was the liability on 1st January 2001, and not even on the 1st January 2001, but till 31st December 2001. This was the liability that remains due or unpaid till 31st December 2001. Again, the next rental was paid on 1st January 2002, and definitely that rental would amount you the amount of that rental is 50,000. And now the interest column. Would the interest be again zero? No, as because on 1st January 2001 the liability was 177,297, and from 1st January 2001 till 1st January 2002, the whole year passed on, and definitely if the whole year has passed on, the liability remains unpaid for the whole year, and the interest would be charged at the rate of 5%. At the rate of 5%, this will make 8865. It means on 1st January 2002, when we paid the rental of 50,000, out of 50,000, 8865 is the amount of interest. So 50,000 minus interest, this will make 41135, which means we paid the principal of the liability of 41135. Out of the liability, that is 177,297 minus 41135, that is the principal paid. The remaining liability at the start of 1st January 2002, that is 136,162 is the liability on 1st January 2002. Now again the another rental would be paid at the start of the year 3, that is 50,000 is the amount of rental. 50,000 is the amount of rental, and again 136,162, that liability remains due for the whole period, for the whole year. Again 5% interest would be charged. 6808 is the amount of interest out of 50,000. If 6808 is the amount of interest, the remaining liability would have been 43192. 43192. It means 136,162 minus 43192 is the amount of principal paid. So the remaining liability would be 92970. 1st January 2004, that is 50,000 is the rental, and 92970, 5% is applied, that is 4649. 4649 is the interest. 50,000 would be deducted from this one. Then the principal that is paid 45352. Total liability was 92970 minus 45352. That is remaining liability is 47618. Last rental was paid on 1st of January 2005. That is the 5th rental, and 5th rental that definitely amounted to 50,000, and 47618. 5% interest rate is applied, that is 2381. Out of 50,000, 2381 is the interest. That means 47619, that is 47618 is the amount of principal paid, which means the remaining liability is 0. So that is the lease amortization schedule if the case of advanced case. So that was the present value of all lease payment. It means 5 payments are included. And when we deducted or paid the first rental will not include the amount of interest as it is paid at the inception of the lease. Now coming to the requirement of exam, that is if we are preparing the extracts at 31st December 2001, income statement and balance sheet. Now you need to concentrate on this one, depreciation and finance cost. First we are calculating the finance cost. Okay, first we are noting out the finance cost. Now how to note down the finance cost? Okay, if we look at this tab, that is at the row where we have 1st January 2001 and we are making the extract of 2001, we find that there is no interest. So is there if I ask you a question, let's ask a question by yourself, that would there be a finance cost nil? Would there be a finance cost nil? Answer is no. Finance cost would not be recognized as 0. Reason being, for instance, the liability on 1st January 2001 was 177,297, and we are making the financial statement at the end of the year, that is on 31st December 2001, and that liability remains unpaid till 31st December 2001. It means the liability was outstanding at 31st December 2001, which means if the liability is outstanding at 31st December, when we are preparing the financial statement, definitely interest would have been recognized or charged. And interest recognized on that liability was 8865. Remember, 8865. It means that 8865 is the amount of interest that is paid on 1st January 2001. But remember that interest belongs to 2001. I repeat my words, what I said, that interest is paid on 1st January 2002. That interest is paid in 2002, but that interest belongs to 2001. So it means interest expense, finance cost for the year ended 31st December 2001 was 8865. So the interest charge for the year ended 31st December 2001 is 8865. Now, what is the amount of depreciation? Amount of depreciation would be calculated while using the right of use asset 242297. 242297 divided by shorter of, that is 5 years, is the useful life 48459. 48459. 48. So the depreciation charge would be 48459. So that is the amount of depreciation should be charged to P&L. Okay. Now let's move on towards the balance sheet side. Definitely we are going to recognize the assets, and in assets we'll recognize the right of use asset, and right of use asset would be recognized as number one, the asset, the cost of the asset, that is right of use, was 242297, and definitely will deduct the depreciation, that is 48459. So the carrying amount of the right of use asset would be 242297 minus accumulated depreciation. This will make 193 and 837. So that is the right of use asset that would be reported in the financial statement as an asset. Now let's move on towards the liability side. And we know that the liability which we are going to record is the lease liability. Will break up, that is the current liability and the long-term liability. Now identify the current liability and long-term liability from this table. Remember, we are preparing the financial extract of 31st December 2002, but so we are not able to find out that year end. We are not able to find out any date, that is 31st December 2001. So remember, let's recall, please concentrate on this table. 1st January 2001, we on 1st January 2001, we had a liability, the total liability of 177,297. Okay, On 1st January 2001, at the start of the year, we had a total liability of 177,297. Okay. If I ask you the total liability on 31st December, so 1st January 2001, we had a total liability of 177,297, and February, March, April, November, and December. Like on 1st January 2001, if we had an obligation of 177,297, definitely we had an obligation of 177,297 on 31st of December. On 31st of December, we had an obligation of 177,297. We haven't paid that amount. Definitely, we'll be paying that amount, but when? On the very next day, in the next accounting period. So on 31st December 2001, we had a total obligation of 177,297. Okay. Out of which, please concentrate this one. Out of which we are going to pay amount in the very next day, in the next accounting period. And what amount we are going to pay? What amount we are going to pay on a very next day, in the next accounting period? That is two things. Number one, the finance cost, and number two is the principal amount. How? The liability that was due for the whole period, that was 177,297. And on that liability, we calculated an interest of 8865. And when that interest was paid, in the next accounting period, that is in 2002, which means we are going to pay an amount in the next accounting period. No. We are going to pay that amount within the 12 months, within the next 12 months. That is 8865. That is the interest. And number two, the principal amount, which will make that 50,000. Which will make what? The 50,000. It means the amount which we are going to pay within the next 12 months. That is the 50,000. So what is that 50,000? That 50,000 is the current liability. Point to be noted. In case of the advance. If we are solving the question of advance. Remember the current liability would always be the rental of the next accounting period. Mark my words, inverted commas. What I said, in case of the advance, we are solving the question of the advance. In case of the advance, the current liability would be the rental of the next accounting period. The current liability would be the rental of the next accounting period. As why? The logic behind it. What is the logic behind it? In the next accounting period, we need to pay two obligations. Number one, the interest that was due for the next for the last accounting period. Number two, the principal amount we need to pay in the next accounting period. So it means the current liability would always be the rental of the next accounting period. Now come back to the long-term liability. Now what is the long-term liability? Out of 177,297, we'll be paying 50,000 as the current liability. So the remaining liability, that is 136,162, that would be recognized as the long-term liability. So that was the case of advance, that how to recognize the values in the income statement and the balance sheet. That was the case of lease agreement. If the lease agreement is signed in advance, which means the rental would be paid at the start of each year.